Hey everyone, welcome back to another video on the channel. It is right before market close on Friday. Got about 4 minutes till the market closes, so I'm going to get the weekend video in right here. So the portfolio is currently sitting at $7,241.72. We are down 177.04 or 2.39% for the day. And you can see as we continue to go back and back and back, it pretty much gets worse and worse. And then also May 31st when we started this portfolio, and we are currently down $642.77 or 8.16% on the all-time chart. So yeah, that is how the portfolio is looking right now. The overall market is down, so it's pretty expected that we follow with it, especially considering our positions. So let's hop into those right now. So starting off here, we have a new T call, which is rolled to next Friday's expiration for $16 a credit. The one that was originally in the money because of earnings, I ended up rolling to this Friday's expiration, and that one ended up expiring, or not expiring, but being worthless. So I ended up opening a new call, closing that one out, and opening up this new call at the same strike for, let's see, $16 in credit. So we are currently up on that by $2. So we made back the full premium plus some additional premium on the roll, and now we're making another $16 on that. So T is actually in a really great spot right now. Very happy with that. Not to mention we have a $30 dividend coming in very soon on November 1st. So T is looking really good. I believe the current price is actually above our adjusted cost basis by quite a bit because of these calls and dividends. So we're actually setting really nice on T. I think I might have been saying key by accident. I'm not sure. If I said key, I meant T. Sorry about that. Moving on down, though, we have the Labu $3 call. I ended up closing out the previous call for full profit today. That was expiring today. And we ended up rolling this out to the following week. So this is for next Friday's expiry, or actually 2 weeks from now, sorry. This is for 2 weeks out because there wasn't much premium for next week. And you can see we're break even on this for $5 a credit, which is a nice little 1.5 or so % return in 2 weeks. So we love to see that. Moving on down, we have these SoFi credit spreads. These things are still getting beat up for the week. I'm not really sure where we stand. I guess we can look here. Yeah, so these went up about $8 overall because I have 2 of them this week. So we lost another $8 on these. $6 now, but you can see still down around $36 overall on this. But the thing about this is I have enough money to roll this into a cash secured put, which was the purpose of opening a spread, was to hedge my downside in case SoFi dumped. And you can see SoFi has plummeted just recently. I believe I want to see when I sold these spreads on the 11th. So let's see where SoFi was on the 11th. Head back a month here. So we literally sold the peak, which is kind of hilarious actually. But you can see SoFi is down 20% since we sold these 2 puts, but we are only down $32. And if you look at the sells themselves, I am down 146, but what's so great about doing a put credit spread as opposed to a cash secured put off rip is that I get to hedge my downside. So you can see the puts that we bought as insurance are up $112. So by doing a spread as opposed to 2 cash secured puts, we've essentially saved ourselves $112, which is honestly amazing. So I'm very glad I did this as a put credit spread as opposed to 2 short puts, because not only does it lower my risk, it also lowers my delta significantly while still collecting a very nice premium. We also have a very low collateral, which is nice about this, only $50 as opposed to $1,500 that we would be holding as collateral for a trade like this that didn't have the long put. And we still collected a really good premium per contract of $11, which is still over the 1% target. So honestly, I think going forward, I'm going to be strictly selling put credit spreads, and then need be, I can roll them into cash secured puts if that makes sense. I may also make a video on that because I think this is a very powerful strategy, because I'm still getting a pretty similar credit to what I would have otherwise. Let's see if I can check that. So you can see I got a credit of $35 if I were to just sell the short put outright. But because I did a spread, I received $11, which, yes, it is $24 lower than what I would have gotten. But you can see my risk is significantly reduced. As opposed to losing $144, we only lost $32. So in my opinion, that extra $20 that we use as insurance is very worthwhile, because now we're able to essentially close this for a huge profit, these long puts, and then we can roll these short puts as just regular old puts and collect a nice credit and be chilling. So that's why I think this is a great play, and I'm not worried about this. And going forward, I believe I'm going to be using this strategy on all my other puts, and you'll see why in just a second as we go down here. Next up, key $11 call. We are up on this, open for a credit of 20. And it's currently at 20. Oh, so we are not up on this. That's for the day. Whoops. So total return is flat, break even. Fine by me. It's a call option. Strike, or rather the price would have to go up by over $100 to reach my strike. So we're chilling on key. Moving on down, we have MPW call. This is doing pretty good. This was part of a caller that I opened on MPW just in case the earnings came out really poor. You can see it did shoot up though, which is great. So we opened that caller for a net debit of $6. So as long as this call expires worthless, we'll only be down $6 because of that caller. But I think it was a great choice just in case MPW ended up dumping, we would be covered, as far down as it were to dump. So I think that was a good play. Even though it may have netted us a small loss, it was incurred because of the risk of the opposite direction. And also we made a lot of money this week on the shares because they are up quite a bit since those earnings. So we made money on the shares. So ultimately we came out with a net gain on MPW for the week. So that is solid. Moving on down, we have the key $9 put. So once again, really wish I opened this as a put credit spread because, it's not down a ton. Key is down since I opened this, but this one doesn't hurt at all, really, to be honest, but it would have been nice to have that downside protection. So once again, going forward, going to be opening these as put credit spreads, but regardless, we still are only down by $10, which isn't much in the grand scheme of things. So that's good. I think we're doing fine on that, and the delta is 25, so I'm not worried about that one at all. Moving on down to ET, Energy Transfer. We have a 13 strike put, and the thing about this is we are very close, pretty much at the money at this point. It's at 13.10. This has a whole nother month to run, so may consider turning this into a put credit spread. In fact, if they do have earnings, I will likely go ahead and do that. I believe they do coming up. Let's see. 11-1, yeah. So we do risk going through earnings holding a short put. So what we're going to do is we're actually going to do this live. It won't go through till Monday, obviously, but we are going to go ahead and convert this into a put credit spread as a way of hedging our downside. You can see we currently have the short put at the $13 strike. Let's go ahead and take a look at what I opened this for credit-wise. So we opened this for $16 a credit. So if we were to trade options here and buy put, we could open this $12.50 put, and we end up actually only coming out with a net credit of $2. So we're paying a lot for that insurance, but on the off chance that ET does end up, getting destroyed, I think it is probably smart to open this trade just in case it does get destroyed. So we're going to leave that floating out there, and this is more of a lesson because, I think this was a fine trade, just that the overall market is down, but I think it does go to show that doing the put credit spread as opposed to the cash secured put actually is a really good way of, hedging your downside. So we'll leave that floating out there. I may end up canceling that order. We'll have to see. I'm going to review it over the weekend and we'll see. Moving on down, the big pain here is Ford. Let's talk about it. So we opened this one for $16 a credit and it's now at 95. So it had earnings and it got absolutely destroyed. You can see this week it started out at $11.58 and we're at around $10. So this is a really bad situation. I honestly had faith that it could go no lower than, probably, I really didn't think it could drop below 11 because you can see Ford has a pretty consistent pattern of bounces at these levels down here at the bottom. So I really didn't think it could go this low, but here we are. So now we got to deal with our trade and, take responsibility for it. So we are down $79 on this. Once again, a great example of why opening a put credit spread would have been a great idea. I believe if I open this as a put credit spread, we would be down maybe $20 because we would have had all that downside hedged. So once again, great example of why a put credit spread would have been a better play that I could ultimately roll into a cash secure put. Because here we are sitting on an $80 loss on what should have been a quick and easy trade. So yeah, a little bit disappointed in this one, but we got to live with it and we got to figure it out. Still $45 of extrinsic value on this contract. So, 50% of this is still going to come off with theta. So, there's a lot of time for this contract to still, expire worthless. It is all the way in December is the expiry. But yeah, I think I'm just going to let this one ride for a little bit longer until I have to think about rolling because of that extrinsic value. So that's what I'm saying we do on this one. I was looking at possibly opening a long leg as insurance, but it was going to cost too much. I want to say I checked around here. I really should have, but it's too late now because we opened for a credit of 16. If we wanted to open a long leg here, let's see what that would look like. I mean, it would have to be all the way at the $9 strike. And at that point, I just don't think it would be worthwhile to do that. So we're kind of just stuck with this trade. We'll let it ride out. And we'll see where it goes. It's got a 58 delta, so it has a high probability of being in the money. My hope is that we could maybe get a small bounce and I could reopen with some insurance, or we just let time run off the clock and slowly decay this, and then I can roll it down and out, or just roll it out over and over again at the same strike, collecting a small premium each time and hoping that it eventually goes out of the money. But we'll have to see. We might also just end up taking a loss on this one. Things can happen. So yeah, we'll see what happens with this, but currently this is the biggest pain in the portfolio. Moving on down though, let's see. SoFi debit spreads. These are down for the week. We now have 3. I've been slowly buying into these. I think I still have one out there for the $30 price. So if it gets down to 30 per spread, we'll open another one. And we'll see where these go. I believe, once again, SoFi, I have that put credit spread on there. And we're down quite a bit on SoFi. If we look at, I think they report earnings soon. 10:30, so very, very soon we will have SoFi earnings. If we get a huge run-up, that would be wonderful. You can see this happened last time we had earnings. Had a bounce from 909 all the way up to 1145. That would be great. That would put our spreads, printing, and that would keep our put credit spreads also printing. So we're very bullishly stanced on SoFi, which I think is probably not a great thing considering they have earnings, because if it goes bust, then that could be really bad for us. But honestly, we're here now and we'll just have to deal with it. Once again, it's a very similar situation to a lot of these plays, is that, you really don't expect this sharp of a drop to happen in the market, that you end up going into these positions that you think are, great ideas, and they really are, but the market disagrees. I mean, you can see SPY's down 4% pretty much for the week from this peak, almost 6%, which is really quite crazy. If we look at the peak, it's down 10.5%. So that's really significant, actually. So we'll have to see where this goes, whether we turn around or we keep going down. We're here to stay, though. Going to keep holding on, so I guess we'll see what happens. Moving on down, though. Now we're into the share positions. Go to total return here. Let's get into it. SPLG, S&P 500 ETF, portfolio edition, so it's a smaller price. This thing has been going down ever since I bought it, but I'm dollar cost averaging, so I'm buying $50 a day, have been for about 2 or 3 months now. And while yes, we are losing on this position, it would have been much better than buying in bulk all the way up here, perhaps at 53, because you can see our cost basis is all the way down at 50.29, which is, let's see, it's around this dip right here. It's 50.29. You can see right here. So yeah, we're really not too far off the mark on this, but you can see it actually is a quite significant percentage of our loss, which honestly, I'm happy that our losses are made up of good long-term plays this time around. I would really be worried about this downturn if we were holding something like ChargePoint, for example, which is pretty much in the gutter at this point. At one point, I was selling cash secured puts on them. I actually had 200 shares in this portfolio. But that's the thing, is like, this is a pretty strong dip, but it's a dip on things that I'm confident in long term. You know what I mean? So it's not like I have to be freaking out that I'm holding some sort of garbage stock that's gonna, file bankruptcy, right? Like, my losses are majority S&P 500, which is a great long term hold. So that's why I'm really, I'm not too concerned. So yeah, you can see there, down 3.9%. And you can also see we have 98 shares. So in about 2 days, we will have 100 shares. And that means we can start trading options, selling covered calls on this, though we really are not in a great spot whatsoever to be selling calls. So I will say that I would like to see a nice balance before I end up selling any kind of calls on this, because I don't want these getting called away. Our cost basis, like I said, is 50.29. So we could sell the 51 and collect $33. We could also sell the 50 and it would be above our cost basis. We'd collect a nice $45. But once again, not really hoping to get these called away. I've been dollar cost averaging for a while now, and I plan to continue to do that until the whole portfolio is made up of SPY. So until then, we're just going to be chilling on this. I did do a bulk buy on this. I have a couple levels that I have limit orders plotted at. So for about 10 shares, I have a couple different levels that I deem, good entry points into the S&P 500 on TradingView. I won't show that here, but I've got a couple drawn up that I've had drawn up for a couple months now of where I would buy more. And now that we're here, we got to go through with it. It's not an impulse buy, and it's also not something I should ignore because the market's dropping, because I plotted these out during a time when the market was bullish, and I was saying, hey, we should get into more shares here and here and here. And we're starting to hit those levels, so I'm starting to buy in bulk at those levels. And so that's why we've jumped up to 98 shares this week, and we're going to keep buying this. So yeah, going to keep getting into this. We're about halfway into our total position on this, I would say, or about, it's hard to say, maybe, I don't want to say 5/8, but that's kind of where we are. So we're a little bit over halfway into this total position currently. So we've got a couple more months of dollar cost averaging before we're actually fully in this. So we've got a lot of time for SPY to either keep tanking so we can get in at lower prices, or for it to recover back to its highs. And if it did, we would be in for a lot of money. So that is exciting. Moving on down though, T. We are down 116. Our adjusted cost basis, though, I'm sure at this point is very low. I would guess we're probably somewhere in the mid to low 14s on our cost basis, meaning we are likely up on T overall. I'd have to check the spreadsheet for that and plug in the new data, but we are doing really well on T. Finally, it's been a while. At one point, it was really bugging me having T in the portfolio, but we're doing good now, so that's great. Key, similar situation. We're in a really good spot with Key. Of course, we were in a better spot at one point when we popped all the way up to 13 almost, but, we're still up on this 6%, and we've been collecting a ton of premium and dividends along the way. So, similar situation with T. We're positive on it, which is great, and it's a really good cash flow machine. MPW had good earnings finally, which is great. We like to see that. We're still pretty far in the bin on this. You can see average cost at $8.50. But we have at least, I would say, $150 to $200 in dividends and call option income. So I would say our real cost basis is about $6.50. So we're actually kind of getting close to breaking even on this. But it's, at least our return is much better than this negative $3.60 that you see here. So it's really not as bad as it looks. Finally, Labu. Once again, another stock that I've collected a great deal of premium on. So the cost basis is much lower than it looks. It is definitely not $5.50. I would say it's probably low fours. Once again, would have to check the spreadsheet, but this loss is not nearly as crippling as it seems. So yeah, and that looks like it's just about everything here. So, once again, buying SPLG every day, selling calls, selling puts, collecting dividends. And, I know it looks ugly now, but I know in, 1 year time, 5 year time, 10 years time, that I'll be very happy that I made this transition into the S&P 500, and I'll be happy that I've been, learning to trade options. So yeah, thank you all for watching this video. Please comment your thoughts down below. Make sure you subscribe, and I'll see you in the next one. Goodbye.